Good morning, everyone. We're going to go ahead and get started. I am Ingrid James, your MBE Services Manager for the Georgia Minority Supplier Development Council. We thank you for joining us today for part 3 of our series, Returning, Rebounding, Restoring. Today's discussion is on how to strengthen your financial plan during these uncertain times, and to provide you with an update on the PPP Flexibility Act that was just signed into law on June 5th. As a reminder, this webcast is being recorded. During the webinar, if you want to ask questions, please type them in the Q&A section. We will read your questions to our guests after their presentations. If you have technical difficulties, please use the chat communication and we will render you some support. Here's what we have for you, what's in store for you today. We are fortunate to have the gentlemen from Parker Poe, Adams and Bernstein LLP, and the University of Georgia Small Business Development Center. We will first hear from the team at Parker & Poe. Parker & Poe has more than 225 lawyers in 8 offices in North Carolina, South Carolina, Georgia, and Washington, D.C. The firm provides legal counsel to many of the largest companies and local governments in the Southeast. Then we will turn it over to Paul Wilson, the Area Director of UGA's SBDC at Georgia State. The UGA SBDC provides tools, training, resources to help small businesses grow and succeed. Designated as one of the Georgia's top providers of small business assistance, SBDC has 17 offices, ranging from Atlanta to Valdosta, to serve the needs of our Georgia business community. Now, I am delighted to introduce the moderator of our first discussion, Alonzo Lorenz, counsel at Parker & Poe. Alonzo has substantial experience in corporate law and presents clients ranging from startups to Fortune 500 companies. Today, he focuses his practice on capital markets and finance and mergers, securities and compliance, corporate governance, minority business enterprise certification, and navigating compliance with MBE transactions. Alonzo is a published author, penning the book The Mirror, a political thriller, and The MBE's Guide to Raising Capital, a financial guide for MBEs. Alonzo earned his law degree at Howard University School of Law, where he was managing editor of Howard's Law Journal. He also earned a bachelor's degree in international trade and finance from LSU. Alonzo, thank you for joining us today. I turn it over to you to give some remarks and introduce your panel.
Good morning. Thank you very much, Ingrid. I appreciate it. Once again, my name is Alonzo Lawrence with Parker Poe. Let me begin, though, by thanking GMSDC for inviting us to participate in this very important webinar. I hope everyone's safe and doing well. Our goal here is to help provide you with the essential information that may help you navigate your companies through this unique moment in time. So we're very, very happy to be here. In today's webinar, my colleagues and I will be sharing insights with respect to the Paycheck Protection Program, or PPP, and the Economic Injury Disaster Loans, or EIDL. Today's insights should be considered an overview of these very, very complex programs. The law in this area has changed and is expected to change further, so be sure to check with your attorney or accountant to discuss your specific situation. However, before we begin, I'd like to introduce my colleagues who will also be presenting during this webinar. First is Dominique Lorero, who is in our Charlotte office. Dom advises companies regarding issues relating to investments, expansions, structuring and raising capital, along with commercial contracting and general corporate law issues. We also have Jeff Cunningham, who's in our Atlanta office as well, who serves as outside general counsel to growth phase businesses, including closely held businesses, emerging businesses, and established companies, advising on all corporate legal issues, including financing and raising capital. Before we begin with the substance of our presentation, there is one housekeeping matter that I'm sure you're all familiar with, and that is the legal disclaimer. I apologize, but we have to make sure we present this, and I'll read it very quick. On the next slide, which says that portions of this communication may qualify as attorney advertising in some jurisdictions. However, Parker Poe intends for it to be used for educational and informational purposes only. This communication also is not intended and should not be construed as legal advice. Finally, given the number of times PPP guidance has been revised, it is important to note the information provided on this webinar is only current as of June 11th, 2020, but the law may change after the airing of this webinar. So with that, I'll hand it over to my colleague, Jeff Cunningham, where we will begin by providing an overview of the Paycheck Protection Program. Thank you.
Jeff, you're on mute still.
Okay, that it works better when you can hear me talk, I think. So thank you, Alonzo. And here we are. The Paycheck Protection Program was signed into law on March 27th as part of the CARES Act. And at this point, most of the serviceable market has either applied for or most have actually received Paycheck Protection Program loans. So the program overview component will be a rehash and probably not a whole lot of new information for most of you. We'll kind of speed through this. The loan size is calculated to be 8 weeks of the applicant's average 2019 payroll, plus 25% of that amount, intended as kind of a catch-all for other qualifying expenses. Note that this is often referred to in shorthand as 10 weeks of payroll, but it's measured, at least in the initial iteration, and Dom will get to the Flexibility Act implications of this measure in a little bit. But it was measured over an 8-week period, so it was really drafted to include 8 weeks of average payroll plus 25% of that amount as a catch-all. This was not an up to amount, but it was a mechanically determined amount, which left a lot of businesses feeling that they were overfunded on their paycheck protection loan and trying to figure out ways to spend the money. That has its own implications. The payroll calculations were subject to some specific limitations and guidelines. The most payroll attributable to any one person that could be included for calculation was $100,000 in annual compensation per person. So that equates to $15,385 each as a maximum loan amount. Non-cash compensation like retirement benefits and group health insurance and payment of the state and local taxes, not the federal taxes in the original iteration, were considered eligible payroll expenses that were not subject to the cap. Commissions and bonuses were allowed to be paid with Paycheck Protection Program loans and calculated for forgivability purposes in payroll costs. The loans are not personally guaranteed and subject to a 1% interest rate, which is highly favorable. Next slide, please. Okay, there we go. So other features of these loans is that principal and interest is deferred for 6 months, and that time period is probably longer under the Flexibility Act. And the entire loan is forgivable if certain forgiveness criteria is met, and Dom will discuss in greater detail the forgiveness criteria. But this forgivability of the loan is what led a lot of businesses to seek these loans and then seek to maximize the forgiveness, the forgivability aspect. and that has had a lot of repercussions as people have interpreted that in different ways. The CARES Act included language that ostensibly required the SBA to target the most vulnerable businesses and the employees of the most vulnerable businesses. And that's, I won't read that all to you here. That was the included in the purpose of the act. It in the beginning, at least, the application of this purpose got a little bit lost in the shuffle, and there's been a lot of discussion and a lot of reaction about that. As Alonzo said in the beginning, the law has been changed through revised guidelines and in application a number of times since its passage on March 27th. And that's why all we can say right now is that this is the guidance that we provide today is likely to change. Next slide, please. To that point, in May, the Inspector General's report noted that the intent of the law was there was no follow through on mechanics with respect to disadvantaged individuals, and there really has been no concerted effort to gather or deal with the demographic application of these funds. If anyone has not already received a PPP loan, there are still some banks, non-banks, credit unions, and fintech players that are still underwriting these loans, and the note here is that they seem to be more open to taking on new banking customers. The reason for that note is that at least in the beginning, many of the traditional banks, even those that were not SBA lenders, that were underwriting PPP loans in this program, were requiring that borrowers move their entire depository and banking relationship to that bank as a condition to making the loan. Perfectly legal and within their rights, but that has proven to be just one of many sticking points for borrowers in this program. Next slide, please. The purpose of the Paycheck Protection loans is found in its name. It's to keep worker compensation coming, to keep people getting paid, because Congress and the Fed have discovered and recognized at this point that when our economy faces a massive and sudden contraction, the business owner's response is to lay people off. And when people get laid off, they stop getting paychecks, so they don't pay their rent, they don't pay their cell phone bills, they don't pay their internet bills, they tighten up on groceries. And as a result of those belt tightening measures at the individual level, there's a cascading domino effect of business failures. So the purpose of this loan was really not to provide the businesses a bridge to profitability. It was really intended to keep people paid so that they would keep paying people. And the same applies to the business, not only paychecks, but paying rent and utilities. And that has, I think, to a great extent, been realized in this economy. Where the Paycheck Protection loans took a long time to get off the ground and rolling, but now most of the money is in the hands of businesses. It's being used. People are being paid. If we surveyed this group, I would imagine that probably holds true here as well. On June 5th, the president signed into law a Paycheck Protection Program Flexibility Act that addresses some of the issues that borrowers have raised regarding the ability to spend the PPP funds as originally passed. So that dovetails nicely into Dom's segment of the presentation, and he'll take over on speaking about forgiveness and flexibility. Dom?
Great. Thank you for that introduction, Jeff, and Alonzo as well, and glad to be here today. Um, as Jeff noted, one of the big features of the PPP program is its ability to have the loans be completely forgiven, so that they're more or less a grant rather than a loan. However, there are important guidelines borrowers must keep in mind in order to ensure that they maximize forgiveness of the loan. First is, do not use the funds on impermissible expenses. There have been some stories in the news, people are getting in trouble for using the funds for personal uses. The main thing that the funds should obviously be used on is payroll. And then there are a number of other uses that can lead to forgiveness of the loan. So it's best to stick within those parameters. There are some other areas that you can spend the funds on and not get that portion forgiven. But as far as optimizing forgiveness, there's really only 3 or 4 categories that the money can be spent on. And importantly, the funds must be spent during the covered period. Originally, this was an 8-week period when the law was passed on the 27th of March. As Jeff noted, there's been a lot of protests from businesses, industry groups, especially those in the hospitality industry who have been affected by stay-at-home orders. Restaurants who they get this money, but they don't have any customers, so to speak. Maybe their sales are down 90%. And so bringing people on to work is not really an option for them. Even if they have the money, the business isn't there and they're not allowed to open. So the PPPFA expanded that covered period during which the funds must be spent to 24 weeks. Now, if a borrower got a loan before June 5th, or even if they were assigned a loan number before June 5th and haven't gotten the funds yet, they can opt to stick with an 8-week covered period. So for borrowers who, were 7 weeks into this program when the PPPFA came out, or even, 3 weeks, they can choose to stick with an 8-week covered period. Now, you may have seen some commentary on whether or not the funds have to be paid and incurred, or if they can just be paid during the covered period. Basically, SBA is looking at this from a cash basis. So as long as the funds are paid during the covered period, they are forgivable. That means an ACH transaction is initiated, a wire is sent, a check is written during that period. So that allows for wages, rent, utilities that were in arrears that may have been incurred prior to the covered period to be paid during the covered period. Also, this allows for certain costs to be prepaid. However, mortgage interest cannot be prepaid, but rent, utilities can. And then in some limited circumstances, expenses will be forgivable if they are paid outside of the covered period. In order for that to apply, the cost must have been incurred during the covered period. For example, payroll that covers the last week of the covered period, that may not get paid to the employees until a week after the covered period ends. That's fine as long as the payment is made on or before the next regularly scheduled payroll date, or in the case of utilities, the next billing date. Again, you have to spend at least 60% of the funds on payroll costs. Before the PPPFA, this threshold was 75%. If a borrower does not spend at least 60% of the funds on payroll, there's going to be a reduction in the forgiveness. There's a calculation in the loan forgiveness application. This was released on May 15th. There's going to be a new one coming out to take the PPPFA into account, but the application that is still out there and you can still review has an equation in there where if you spend less than 60%, or in this case 75% on payroll, SBA will do a calculation so that payroll costs equal exactly 60 or 75% of the amount that is forgiven. So there's a way to true that up. The third bullet point says that there might be a cliff effect where if you fail to spend 60% on payroll, even if you spend 59% on payroll, there would be zero forgiveness. There have been some informal pronouncements, statements from the Secretary of the Treasury and the SBA administrator that have said that no, this is not going to be an all or nothing. If you spend less than 60%, you'll get partial forgiveness so that payroll costs equal exactly 60% of the amount that's forgiven. We're waiting on an official regulation to come out, but all signs indicate that it's going to be a situation where partial forgiveness is available and it's not an all or nothing. Next slide, please. Okay, so payroll costs include gross compensation paid to employees. That's your traditional understanding of payroll. Again, this is gross, so it includes certain state and federal income taxes. It does not include the employer share of FICA or Social Security and Medicare tax. That is all subject to a cap. Cash tips, payment for vacation, severance payments, again, those are equal to the cap, which is $385 over the covered period. Now that's with an 8-week covered period. That may be enlarged now that we have a 24-week covered period. However, payment for the provision of employee benefits like healthcare coverage, premiums, retirement contributions, those are not subject to that cap. Neither are state and local taxes assessed on compensation to employees, such as state or local unemployment taxes. Next slide, please. Okay. Again, the payroll cost calculation method is a little bit different for owner employees, those who are self-employed, sole proprietors. That's equal to the lesser of the annualized portion of $100,000 for the covered period, which comes out to that $15,000 figure, or the actual compensation in 2019. So this prevents self-employed owner employees from increasing their compensation to be higher than it was in 2019. You must maintain the qualifying full-time equivalent employee headcount during the covered period. So if the full-time equivalent employees of a borrower are lower during the covered period relative to a prior reference period, there are 2 prior reference periods that borrowers can choose. If it's lower during that period, the forgivable amount will be reduced proportionally. So if a business had 10 employees on payroll during the prior period, but only 9 during the covered period, that's 10% less. So the forgiveness will be reduced by 10%. It's a very simplified explanation, but roughly what it is. However, even if you face a shortage of employees or a reduction in employees, as long as the employee count as of February 15th is restored by December 31st, that proportional reduction will be set aside. It will not happen. Importantly, those reductions have to have occurred between February 15th and April 26th. So the loan forgiveness application goes into much more detail on how you calculate that. But if there were no layoffs before April 26th, but there were afterwards, keep in mind that this so-called FTE reduction safe harbor cannot be used. Next slide, please. Okay. Again, you must also maintain 75% of the salaries and wages of certain employees. Those are employees who were paid less than or equal to the annualized equivalent of $100,000 in 2019. So what that means is if somebody came on at a salary of $120,000 in September, their pay for all of 2019 is going to be less than $100,000, but on an annualized basis, it's greater than $100,000. So those employees who make more than $100,000 are not subject to this requirement. Also, if employees were not employed by the borrower in 2019, reducing their wages by more than 25% relative to their average wage during the first quarter of 2020 will result in a reduction in forgiveness. There's a complicated formula for this that you can find in the loan forgiveness application, but what it does is it looks at the pay during the first quarter relative to the pay during the covered period. Given that they're different lengths of time, they kind of get an apples to apples comparison. So you can see, okay, this is what the person would have made at this wage rate if the covered period had been for an entire quarter. This is how much it falls short of their prior pay, and the amount of that excess is the reduction in forgivability. Again, like the full-time employee count, you can restore wages in full, not partially. You have to restore them in full by December 31st. You may have heard June 30th previously. That was the case before the PPP Flexibility Act, but now it's December 31. Next slide, please. Okay. Again, you can use the remaining funds, but no more than 40% of the loan amount on permissible expenses. Utilities, rent, and interest on pre-existing mortgage obligations can be forgivable, but the contract for these obligations must have been entered into before February 15th of 2020. The CARES Act specifically allows borrowers to spend the funds on interest on pre-existing indebtedness that is not mortgage, so credit cards, for example, and other permitted uses that you could use any other SBA 7A loan on, such as inventory, supplies, raw materials, and working capital. However, keep in mind that in addition to having to stay within this 40% threshold, those last two expenses will not be eligible for forgiveness. Next slide, please. Okay. Again, as I noted before, not all allowable uses are forgivable. The example of interest on non-mortgage debt, that's allowable, but it's not forgivable. If the loan is not forgiven in whole or in part, the portion of it that is not forgiven will be due in level payments for 18 months after the date that a borrower applies for forgiveness. This will be longer for loans made after June 5th because the terms of those loans can be no less than 5 years. For those loans that were made before June 5th, borrowers and lenders can enter into an agreement to expand the maturity to be longer, but that's up to the bank to allow. And there are no prepayment penalties. And next slide, please. All right, and I'll turn it back over to one of my colleagues.
All right, thanks a million, Doug. This is the section relating to certification of need, which has been the source of a substantial amount of, as you guys probably know, angst and concern. As you know, the application provides that all applicants have to certify in good faith that, quote, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Hence, this need test that everyone refers to and has been the source, as I mentioned, of a substantial amount of angst because of its subjective nature. The applicant, in order to be able to provide some level of good faith assurance or certification on this, as a general matter, we've been counseling and most folks have been trying to assess a few things. One is the current business activity of the entity itself. Another is the current economic uncertainty surrounding and the impact on the business, the impact of having versus not having the PPP loan, and the access to other sources of liquidity. These are factors that one can consider or have considered and can consider to Jeff's point. There may be opportunities even at this stage as you analyze whether you can in fact meet this certification, this need requirement. To address the uncertainty, there were safe harbors in place. As you probably know, the first safe harbor ended May 7th, but it was extended until May 14th. And essentially that was intended to provide a mechanism whereby if you did feel uncomfortable that the need certification was not met, you could return those funds and there not be any ramifications or adverse ramifications, at least knowing, based upon the information we had. Yet there was still uncertainty. So the SBA finally issued additional guidance that we think really helped a lot. And that is that it provided an additional safe harbor saying that to the extent you have a loan that is $2 million or less, there is a presumption of need and that you probably will not be called upon to defend your certification of need. However, there is no assurance, but at least you have a presumption in your favor. And of course, if you're over 2 million and there is an issue as to whether there is adequate need, certification was not in the government's view appropriate, then you would be asked to return those funds. Next slide, please. Finally, there are some best practices that we have been providing or recommending in terms of the application and the forgiveness. And these apply not only to the loans themselves, but also as a general matter, just represent good corporate governance. The first one contemplates your speaking with your board of advisors, with your CPAs, with your attorneys, to ensure that you analyze these issues, that there is a methodology in place, as we'll be discussing in a second, but also that you want to make sure that all of the factors that were taken into consideration as you went through and go through this process are documented. You want to document as much as reasonably possible. So for example, you should have or consider having a model where you have a best case, middle of the road, and a worst case scenario. And this should be analyzed and vetted through management all the way up to your board of directors for approval. Because once again, going as a matter of going to the question of whether you have good corporate governance in place, you've now shown that there was a reasonable basis in terms of your analysis and the decisions that you made going forward. Finally, we recommend that you segregate your funds. You put these funds from the loans into a separate account to track permissible spending. This is good because it also allows for ease of accounting. So those are 3 general recommendations that we recommend you consider. But once again, these are just good from a corporate governance perspective also. Jeff will take it from here in terms of the EIDL.
Thanks, Alonzo. So the EIDL is a program. It's an economic injury disaster loan that was actually introduced in January, and prior to all of this coronavirus activity, and was enhanced as part of the CARES Act. The EIDL is not a forgivable loan, generally speaking, but it does have favorable terms for the permissible uses. The loans, I'm just going to run through the features here. They're not personally guaranteed. They have a repayment term of up to 30 years, but we'll talk about on the next slide what that 30 years might look like. Principal and interest payments are waived for an entire year, so it's free use of the money for a year to determine how long, whether you actually need the money a year from now. 3.75% interest rate. It's not personally guaranteed, but it is secured by all assets of the business for loans in excess of $25,000. There's no prepayment penalty. So one of the features that I have talked about with a number of clients who have decided to take this money is that they plan on taking it, putting it into a separate bank account, holding it for the next year or 11 months, and deciding whether they actually need it or not, and then returning it at the end of 11 or 11 and a half months before principal and interest kicks in. There was a pretty widely hyped $10,000 advance that was introduced as part of the EIDL package back in March, and that turned out to be not a $10,000 advance, but an up to $10,000 advance that's based on the number of employees at $1,000 per employee that the borrower has. And if a borrower gets an advance under the EIDL and also gets a PPP loan, then the advance funds are deducted from the forgivable amount under the PPP loan. So there has been some effort made to avoid double dipping here. Next slide, please. This generally favorable loan does come with some hooks, so it's worth noting before you just sign up. If you get this type of secured loan, be sure you look at any other existing loan terms that you have, whether that's for a term loan or a line of credit, as the additional indebtedness that's granting to the SBA and all assets security pledge could violate your existing loan terms. The borrowers must obtain the SBA's approval to move to a different location. Some of these conditions make it very clear that the original intent of the EIDL was to help and foster rebuilding in local areas that have been hit by natural disasters, fires, floods, earthquakes. So some of these terms don't necessarily make obvious and intuitive sense in a national general lending program, but they're in there nonetheless. So one of those is this obtain the SBA's approval to relocate out of the affected disaster area. You must obtain the SBA approval to sell or dispose of assets, since this is an all assets pledge. That would include, for example, as written, trading out a laptop. That is a business asset. I don't think that that's what the SBA actually intended, and I don't think that they want to police businesses disposing of 5-year-old laptops. But the terms as drafted would include that kind of activity. Loans that were made between January 1st and April 3rd that were used for payroll must be refinanced with PPP funds to the extent that the borrower obtains PPP funds. And EIDLs cannot be used for the same purposes as PPP, although the permissible uses track very closely. So what that means is if you have both a PPP loan and an EIDL, then you need to be able to say what you spent the funds for each one on, so that you're not spending the same dollar twice for purposes of credit. I've kind of sped through this, and I urge anyone who has questions in addition to this to reach out to any of the three of us for further clarification, and I thank you for your time.
Thank you, gentlemen, for those insightful updates to our attendees. We will share the slides with you all at the end. And the posting of this recording will be on our website in a few days. Now we're going to see a short video clip on thinking agile from the strategic team at Accenture.
Organizations today are stretched to their limits in the ever-increasing pursuit of innovation, quest for agility, hunt for productivity, and desire for engagement. Today's operating models are better suited for a time when the major competitive strategies were focused primarily on either scale or local responsiveness. Yet some players have proved that scale and responsiveness aren't mutually exclusive. By gaining competitive agility through operating models that continuously keep pace with the market.
To help clients be poised and ready to respond to change with speed and agility, they need a new operating model, an intelligent operating model. The fundamentals stay the same. Successful organizations are aligning their strategy with their business model and operating model.
Our research in collaboration with the World Economic Forum has identified 5 characteristics that are essential for gaining this level of agility: human, liquid, enhanced, living, and modular. Many organizations are looking at 1, maybe 2 of these characteristics, but our research shows the key to unlocking real transformative change is to look at the right combination together. Let's take a little closer look at each and the benefits they bring.
Agile organizations have an operating model with an emphasis on the human element. It helps employees find individual purpose in their work, offers a personalized employee experience, and encourages an entrepreneurial mindset.
Companies embracing a liquid operating model are porous, open to seamlessly access people, processes, systems, and assets outside their company. In today's market, most businesses cannot go it alone, and a liquid company seeks out the benefits of an ecosystem.
Enhanced. Automation and artificial intelligence are transforming functions and ultimately each worker's role. But digitization is not about replacing people with machines. It's about complementing human capabilities with technology and looking at physical and virtual space.
Living. Living operating models are more organic than organization. Self-organized teams are flexible and nimble, willing to disrupt the status quo to act quickly and prioritize progress over perfection.
And finally, intelligent enterprises are increasingly modular, using multiple operating models to run the core business. They respond faster to their customers, effectively partner with a wider external ecosystem, and quickly drive new offerings and innovation.
How companies apply these characteristics to each part of their business could be different by product, by region, by business unit, but all 5 attributes should be applied and flexed across all parts of the operating model.
All right, this video was a good way for us to segue into the next component of our webcast today. I do note that there are several questions that are in the Q&A section for the first group, and we will get to your questions after Paul's presentation. Our next guest is Paul Wilson Jr. He is the Area Director for UGA Small Business Development Center. He is an innovative and effective entrepreneur leader with nearly 20 years of experience creating and delivering high-caliber consulting, training, and solutions to large corporations, small businesses, nonprofits, and professionals at all levels. At SBDC, his team provides consulting services, market research, business resources, educational support to startups, growing businesses, and mature small businesses in order to help them achieve their short and long-term goals. His extensive industry expertise spans the gamut from supply chain, supplier diversity, small business development, to strategic planning, organizational development, process improvements, leadership development, government contracts, and curriculum design. Prior to joining GSU, he worked in several Fortune 500 companies. He also was a consultant for multiple NFL football teams and taught at a university. He too is a publisher, author, actor, and youth development advocate. Thank you for joining us, Paul. I turn things over to you.
All right, thank you, Ingrid. It's a pleasure to be here, and definitely appreciate the presentation we heard earlier. Definitely very informative from the Parker Poe team, helping businesses, again, just really understand, this whole kind of disaster loan environment. And you can go to the next slide. The SBDC, we've also actually been very involved with helping businesses kind of navigate this space on the financial side, and in terms of helping them really understand a lot of the information that you heard a little bit earlier. And then also, again, because again, in the way SBDC is set up, and actually you can go to the next slide also, we work with companies across the entire state. We have 17 locations to assist businesses with really every area of your business except for 2. So we don't do tax advice and we don't do legal advice. But other than those 2, as it relates to your business strategy, business planning, and then we'll talk about some of that actually in this presentation, but marketing, operations, HR, contracting, whether it's at, again, the government level or the corporate level, we assist businesses in a lot of different areas, a lot of market research we assist businesses with. We don't write business plans, but we help you get your business plan lender ready. As again, oftentimes, again, as you move forward, you may not aren't focusing on the disaster loans, but again, lending or funding in terms of acquiring capital in a traditional sense, if you will, from that standpoint. So we cover a lot of ground when we work one-on-one with our clients. And one of the best things I haven't mentioned yet is that our services actually are free, or as I like to say, prepaid. We are funded by the SBA, as well as the University System of Georgia. So it allows us to invest back into the small business community, if you will. So again, whether you contact my office, which I lead the office at Georgia State University, or one of the other 16 offices, as you see on the map, we pretty much cover the entire state. And so you can get assistance from any one of us from that standpoint. You can go to the next slide. So as we, again, begin to, hopefully your business is in position to start recovering. But if not, hopefully, again, you were able to apply for a PPP loan or an EIDL. But again, since as we transition away from those actual things that are happening, and actually you can go to the next point. So you can go, well, pull up all three. I'm gonna cover briefly kind of three areas, just to give you some food for thought. I have not time to go deeply into each area, but some things as you begin to transition from what I call maybe from recovery to a little bit more stability, but then hopefully, you know, growth at some point in time later this year. But we know for different businesses, it's going to be a different pace, right? Just based on your industry and kind of what's happening with the health pandemic and how it's actually impacted your business. But in terms of this presentation, we're going to cover it again just really briefly. Talk about your money, determining some cash requirements, and again, just to give you some things to think about. Your communication strategy and your operations, and specifically related to creating and documenting processes. You can go to the next slide. And you can go ahead and pull up all the bullets, and I'll just kind of speak to all of them. So as you think about your cash, right, you want to think about some really things that really actually kind of hit a couple of businesses kind of hard, even as it relates to maybe applying for one of these either EIDL or PPP loans, where how are you tracking your dollars? So what systems are you using, whether it's QuickBooks or something else? Hopefully it's not pen and paper, right? And even a spreadsheet is good, but it's probably not adequate. I'm sure these gentlemen could probably let you know that. Also that, again, you want to have a system that not only tracks your revenues and expenses, right, but also categorizes them the right way, so that whether you're having to report back on the disaster loans or just your reporting overall, right, working with your CPA as it relates to your taxes and those things along those lines, the better you track it along the way, right, the more efficient it's going to be to just get your reports and then to provide the information that's needed, again, whether it's a disaster loan or just really business management overall. And so as you think about the process of also not only tracking, but also calculating how much capital do you actually need to survive, and not just over the next 2 months. What about the next 6 to 9 months, or maybe even the next year or 2 years? Because none of us know exactly, right, when this thing is actually going to turn around completely. So your planning process needs to be very extensive, and that's actually one of the areas where, as the SBDC, a consultant can assist you with that. Really looking at, again, your profit and loss statement, your cash flow statements, even your balance sheet, and projecting out. Again, not just in the short period, but a longer period of time. And then other things around how can you limit your expenses, right? What are some things that you may be able to negotiate with the landlord or the utility company, right? Or even other creditors that you may have to either reduce or delay, right, paying certain expenses, because right now cash is king, right? And so which really, I guess we say that really in any time of business, but it's definitely critical right now from that standpoint. So again, can you limit your expenses or delay those expenses as we kind of get through this not a little bit, but for me, this has been a lot of rough terrain from that standpoint. You can go to the next bullet. All right. And again, and this gets back also get to your financial reporting. Hopefully you're doing this all the time anyway, but definitely it's a critical time right now to really understand, right, in the in-depth aspects of your business. And again, if you don't know how to do financial reports, get some help, right? If you don't know how to do them, but when you read them, it looks like, a foreign language. Again, for many people, finances are a foreign language. So that's absolutely something that you want to get help with. There's no shame in that. It's better that you get help and learn in the process than to not get help, because again, you're concerned about what somebody's going to think about you being a business owner and you don't really know these things in detail. Hey, get some help. And again, we're not here to shame you, make you embarrassed. We're just here to help you as much as possible move along with your business. So again, your cash is going to be critical during this time. You can go to the next slide. All right. And then assets, of course, are part of that conversation. And again, and even in terms of right, limiting expenses, maybe there's some assets you don't need. Maybe you can actually sell some assets to raise some cash from that standpoint. So again, as you're doing your overall financial evaluation, all these things come into play. All right, you can go to the next slide. All right, and you can go ahead and just pull up all the bullets. So we talk about communications, right? And there's really communications across so many levels. One is you want to communicate to your customers and to the public. So have things changed, right, with your operating hours or even how you're doing business? Again, if you're a restaurant, are you just doing curbside service and delivery? Or although you may have been closed, several weeks ago, but now are you reopened to the public and inviting people in, but maybe just fewer people at a time? Those are all critical changes that you want your public to know, because again, you don't want anybody to assume that you're open and that you're not, or that you're doing things. One restaurant or one business is overall, not just restaurants, but one business overall may be doing it, but you may be doing something differently. So don't assume that everyone just automatically knows. So again, whether that you're going to use your website to do that, your social media, physical signage, anything that you can do, again, to keep people informed, to keep them up to date, is going to be critical right now as it relates to retaining maybe current customers, but also other customers. And again, you want to be aware of how do people normally get information about your business. Are they Googling you? Are they looking at your social media? So you want to make sure that whatever platform that you're on, that it's consistent information across every single platform, but also, again, it's accurate information. And then even proactive information, right? So again, even if you're using things like email marketing, right? Are you using that? Are you keeping your email list accurate, but also people up to date with the information? But also not just for customers and the general public. What about your employees, right? Again, so many people right now are working remotely. It probably makes sense to over communicate right now, right? Because think about when you're in the office, you're oftentimes having conversations, just popping in people's offices or walking down the halls, right? Well, those conversations are a lot harder to have right now. So you really almost have to, not really almost, you really have to have much more structured conversations and using technology to do that. And again, in many cases, over communicating, because again, you got to think about, you're not having those kind of one-off organic conversations anymore. And I kind of joke with people now, it seems like I'm busier now working at home than I was, before this kind of whole thing started. And why is that? Well, because a lot more of my meetings are now on my calendar, where before, again, they were just more, again, organic, if you will. So again, make sure that you're letting employees know changes in operating procedures and regulations, and things that are again, in some cases you have to do, right, in terms of your business is about to open, and things that you didn't have to do before. But also, again, if you're having to communicate or operate differently to the general public, you have to train your employees maybe a new way of doing business that you didn't have to think about before. So yes, you've implemented some new processes and procedures, but all of your employees are aware of the same things. So again, that's critical, again, of keeping them up to speed too. And then even things like when you think about, I already talked a little bit about creditors, but also maybe vendors, right? How's your supply chain potentially being impacted by this process, and making sure that, again, if you're the type of business that has to purchase products or services in order to, transform that into something that you're selling to your customers, making sure that you're aware of what their challenges are, what's going on with them too, so that, again, you can kind of keep your supply chain flowing and things aren't being encumbered by lack of communication. We know other things can kind of clog up the supply chain right now, but you kind of want to keep that flow going. And then you can go to the next slide. And again, kind of talk about this, the communication piece again. So definitely your marketing overall, your business operations, again, your staffing plan. Again, as things have changed and shifted, you may have to think completely differently about how you're staffing. Everyone says work from home. Well, every business model isn't built for working from home. So do you have to change your business model, or do you have to adjust your model to maybe accommodate that, if that's what you weren't doing before? So all those things are things actually that I'm throwing these out here as questions and things for you to think about, but these are actually all areas that a business consultant from the SBDC can actually help you with, think through it, and actually put in some operational plans and strategies and tools to help you transition. You can go to the next slide. All right, and you just kind of bring up all the bullets. So again, and now you were just talking about, again, documentation. Again, sorry, I just want to respect everyone's time, but again, just want to bring up some thoughts for you to kind of focus on as you, again, begin to transition kind of into this next phase. So again, even with the social distancing recommendations and physical characteristics of your workplace, you may have to completely rethink your business, right? as people come back to it. As I said, I work for Georgia State University. They are completely rethinking how they're going to deliver education, right? And technology is a part of that, but also the physical space and the use of physical space on our campus, because we can't completely abandon all the buildings that we have, right? So everything can't just go straight online. So again, so they're really thinking through strategizing, you know, what's the best way to do that. And so you may have to think about that again for your business also, but also new procedures, not just social distancing, but also cleaning and disinfecting, right? What's your current processes now that may have to be enhanced, which they do, right? But also, and not only enhanced in terms of maybe what you're doing, but how often things are being done in terms of cleaning and from that standpoint. But then also, again, are there new technologies, not necessarily new, but are there technologies that you can utilize in a new way, let's put it like that, that can assist you in this process to maybe in some cases make your business more efficient. Maybe there are some ways to actually take some costs out of your business by implementing technologies, again, that either you weren't doing before, or now, again, it's a new opportunity. And it's interesting, you know, just being at Georgia State University, where, you know, they've been pushing to go have more distance learning online anyway over several years. So that's a little bit of a silver lining right now, that they've kind of been forced kind of to do that. But now it's going to be even more common. But again, a lot of universities and you know, are going that route from that standpoint. You can go to the next slide. I'm going to kind of wrap up here. But again, and you can kind of just pull it all down. Yeah. So all these questions, again, of course, have financial consequences. So in each of these areas, whether you talk about technology, whether you talk about staffing, whether you talk about operational changes, whether you talk about, again, enhanced cleaning, right? You know, less people that can be in a space at one time, and especially if you need more people, right, to drive those revenues, right? All of these issues have financial consequences, and so again, oftentimes it's critical, right, to have someone else to be able to help you walk through that, to really understand, right, in each of these areas, how to do it efficiently and effectively. Again, your customer employee expectations of a safe environment, right, are paramount in this process. So you have to think about not just yourself as a business owner, but you have to think about the concerns, right, and needs of your customers and your employees in this process. Again, the speed of the recovery remains, it's a function of customer demand and available resources, right? So although we want things to happen faster and we're ready to open, let's say as a business owner, but if the customers aren't coming back, right, now you got to think of other strategies. Now you may need to increase, as I talked earlier about decreasing finances, but in this case, maybe you're shifting finances more into marketing, because now you may need to get more aggressive in your marketing. Let's say if you've never done social media marketing, that may be an area where now you have to do more. People are spending more time online. So maybe that now they actually will see your ad, where before, as you know, maybe your target audience may not have been paying as much of attention. So again, those are all strategic decisions as a business owner that we can assist you in helping you kind of figure out which way to go. And again, in business, again, change is the new normal, right? Everyone's saying the new normal. Well, actually, change is the new normal, and in some cases, uncertainty, right, is the new normal for every business right now. But again, you know, we have resources and tools and research available to help you navigate during this time. You go to the next slide. So again, we have a lot of resources available on our website as it relates to your business, again, in terms of response and recovery. Of course, the CDC has all the guidelines, again, also as it relates to opening procedures, and of course the state of Georgia does too, there with the Georgia Chamber of Commerce. So again, we have a lot of resources available. Again, we're here as a resource, also as a consultant, so you can contact our office directly. And again, even if you don't live in the metro Atlanta area, you're across the state, we can help you get to the closest location to you, although all of our consultations right now are virtual. So it really kind of doesn't matter. But again, if you want to get connected with a local resource, those consultants may have a much more relevant understanding of those local areas. So still may be very important for you to connect locally, although again, everything is being done virtually for now from that standpoint. So definitely thank you all for your time, and look forward again, I guess, if we have time for any questions along with everyone else to be able to answer any questions that you may have at this point in time.
Thank you, Paul. I know we're running a little bit over, but I do want to take a few moments to answer a few questions. And then what we will do is capture the questions and make sure that we have an opportunity to share these questions or pose these questions to our guests and make sure that they have an opportunity to answer them. and we will provide you with those answers in our post webinar email that goes out to all of you attendees. So now, Otis, will you go ahead and let's just ask like the first couple of questions that did come through.
Fantastic. Thank you, Ingrid.
And if
First
all my
question.
speakers could unmute so that you can take an opportunity to answer.
First question is it common that banks have a separate forgiveness application versus the one found on the SBA site? Started completing the form and was told by Chase that they had not issued their forgiveness form yet. Is this unique?
Jeff, you.
I can take that one. The answer is quickly no, that's not unique. One of the features of the PPP program that's different than other SBA lendings is that in this case, the banks were lending their own money. In a usual SBA lending construct, the bank is the collector of information and they ship everything with the application and all of the backup documentation up to the SBA. The SBA evaluates and approves it and then sends back to the bank the approved loan package and the funds so that the lending bank can lend you SBA money. In this case, the banks are lending their own money and are relying upon the SBA to fund the repayment of the loan, and that's how the forgiveness works. So every bank lending its own money has its own form for applications for forgiveness, and they may look largely the same, but there'll be a slight variation from bank to bank. So yes, I hope that's a good answer for you.
Thank you. There was a continuation of that when it says that Slide says bonuses are part of payroll calculation. Slide says bonuses are part of payroll calculation. What about owner distributions?
Don, you want to take that one?
Yeah, I'll take that one. The guidelines, unfortunately, on partnership ownership distributions, guaranteed payments, that's not as clear as it could be. But based on a rule that came out, they should be allowed to be calculated as part of payroll costs on the front end when the loan size is determined. And then yes, there's some ambiguous language in the regulations that say that payments to owner employees will be forgivable up to that cap. It's always up to that cap, being the lower of the annualized portion of 2019 compensation or $15,385 over the covered period. Given that it's a bit ambiguous, and as the banks are the gatekeepers of forgiveness, what we're advising clients to do is when there is a question about that, ask the lender. They're going to be the ones who are making that determination. Tell them how you've seen the guidance, that this is an owner distribution. It's made in this course, because really, just given the volume of these loans, the size, the number of them, SBA is pretty swamped right now, and may not be able to get to questions specific as that. And for all practical purposes, checking with the lender, seeing what they're going to process is the best route to go.
Fantastic. Thank you, sir. And in keeping with the spirit of keeping on time, we're going to read one more question, then we're going to return everyone's afternoon to them. If you have a significant amount of funds in a 401, would you suggest using some of those funds and pay yourself back with interest? I know that this takes it out of circulation in the market, but since there are no taxable penalties, this may be more attractive. What are your thoughts?
You want to try that one, Jeff? Or?
That sounds more like an SBDC question. That's kind of financial advice, and attorneys get scared away by those kinds of questions. I can talk about all of the iterations and kind of decision tree analysis on how that might turn out if, and how that might turn out if, but that's not really a legal question that I'm comfortable tackling on short notice.
Sure. And what I'll say to that is we definitely do a lot of financial analysis But one of the things that we don't do and not allowed to do is tax advice. So there's there would be some tax implications to those too. So that question actually may be better for I'll call it a tax attorney or a CPA would probably be best to answer that specific question.
There's definitely some modeling, and you have to make a set of assumptions about if the market does this, then you're better off doing this way, and if the market does that, then you're better off doing it a different way.
Thank you. So we'd like to thank Alonzo, Jeff, Paul, and Dominic for all the insights you provided. And Ingrid, I'd be remiss if we didn't thank you at this time as well. We'll let you go ahead and have any closing remarks or conduct that part of this session.
Well, I just want to say thank you, Alonzo, Jeff, Dominique, and Paul. We appreciate you taking time out of your day to speak with our MBE community. MBEs, thank you for hanging in there. I know we ran over a little bit. This webcast has been recorded and will be available in a few days on our website. We will also share the slides with you all via email. If you found this webcast beneficial, we ask that you please help us share it by you sharing it with your network. And GMSDC invites you to stay connected. We will be hosting a How to Do Business with UPS next Thursday with 25 live opportunities being discussed. And on the 24th of June, we're going to be hosting a How to Do Business with Truist. This does conclude the webcast for today. Thank you everyone who tuned in. Stay safe and healthy and have a great day.